Hello everyone, my name is Daniel Patrick, and today I will be talking about some of the biggest lessons learned in the Financial Accounting Systems class. During this presentation, I will discuss accounting ethics, GAAP and how it relates to ethical accounting, the accounting cycle, cost management, and how financial statements affect the decision-making of a company's leadership. Accounting ethics is a very vital aspect of preparing accounting information. It is very important for a person preparing a company's financial statements to do so ethically. Ethical accounting ensures that the numbers a company is presenting in their financial reports are accurate and are not skewed in any way. Any kind of unethical accounting can lead to numbers being presented to investors that are very misleading. Ultimately, unethical accounting could lead to more problems for a company in the long run. This is because the company might be trying to hide their shortfalls instead of looking for solutions to better their situation. One of the biggest ways to ensure a company is using ethical accounting procedures is by making sure they follow GAAP. GAAP stands for Generally Accepted Accounting Principles. By following the guidelines set in place by GAAP, a company and investors can be sure that the accounting information being presented was prepared in an ethical manner. In order for a company to meet certain standards, they must ensure that financial statements are prepared using GAAP. Even though all the principles of GAAP help ensure ethical accounting, two of the biggest principles presented in GAAP is the principle of materiality and the principle of utmost faith. The principle of materiality means that accountants must strive for full disclosure in financial reports. And the principle of utmost faith means that anyone involved with spending or accounting for a company's money or profits must remain honest with any and all transactions. The accounting cycle is a process used to record and account for any transaction a company makes and ensures accountability for those transactions throughout the reporting period. The cycle starts with any and all transactions a company makes during a reporting period, and it ends when accounts are closed and the company has a final balance for the reporting period. The accounting cycle consists of 9 steps that ensures a company is doing everything it needs to in order to properly track their financial situation. The first step is a collection of data, which is also known as the analyze step. The main concern of this step is to determine which accounts are affected by a certain transaction. The next step is journalizing. This is the process of recording the information about the transaction into the company's financial books or records. After that comes posting the information into the company's ledger. This is done using a T-chart, which consists of debits on the left side of the chart and credits on the right side. Next will be preparing the unadjusted trial balance, which is also known as the summarize step. One of the biggest things to do during this step is to ensure the debits and credits are equal to each other. During the adjusting step, the numbers from the unadjusted trial balance are updated to ensure they are reflecting the most accurate numbers. Once adjusting entries have been made, the next step is to prepare the adjusted trial balance with the most accurate and current numbers. These numbers are important because they are the ones used to create the company's financial statements. The financial statements are also known as the organizing step. The income statement, balance sheet, statement of owner's equity, and the statement of cash flow are some of the biggest financial statements prepared during this step. Next comes the closing step. In this step, all nominal accounts are closed out so they can start over for the next reporting period. Finally, the post-closing, also known as the finalizing step, is where the final trial balance is prepared for the reporting period. This also serves as the basis and starting point for the next reporting period. Cost management is a very important aspect of business for any company to pay attention to. One of the biggest factors of cost management is cost drivers, which are factors that affect the overall cost of a product or service. Cost drivers can usually be classified as fixed or variable. A fixed cost is not affected by the amount of production a company generates. However, variable costs do go up or down depending on how much production is currently happening in a company. A cost driver can also be direct or indirect. Direct means the cost can be directly linked to the production of a particular product, whereas an indirect cost cannot be directly linked to the production of a particular product. A cost management system is important for a company to have in place in order to ensure they are making the most cost-effective decisions for their business without negatively affecting their customer service. Financial statements play a big role in helping managers and company executives make decisions for their company. The main statements they use are the income statement, balance sheet, statement of owners or stockholders' equity, and the statement of cash flow. It is important for leaders to make sure they are checking for red flags that might show up in their financial statements. Additionally, it is important for those leaders to take the information they have from their financial statements to make the right decisions to help the company continue to grow. In conclusion, we discussed why having ethical accounting is vital for a company to present honest numbers in their financial reports, and how following GAAP can ensure that those reports are completed ethically, as well as how the accounting cycle helps a company keep track of all transactions throughout the reporting period. Additionally, we discussed how cost management and financial statements go a long way in a company's leadership making the right decision for them to continue being a successful business. These are the references I used to create this presentation.